You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Katie Kaminsky, Jim Kazan, Rob Carver, Mark Resipczynski, Rich Brennan, Alan Dunn, Nick Baltus, Andrew Beer, and I, Niels Kostrup-Larsen. As you can tell from this introduction, today as well as last week's episode are very special because it's the first time all 9 of us are together for one big conversation and debate. As you may remember, we did unfortunately due to some technical issues lose Rich during our recording, so that will explain why they are not so active in today's conversation. But without further ado, let's continue our conversation where we left off last week. I know that Rob already stole one of your topics, but your list was pretty long, so hopefully you have something else.
Well, I think, first of all, I think just going back to, I guess, the question that I would ask, we're trying to define trend following. I'd be curious how people define non-trend, because, back when we started in 2015, machine learning was a big thing, and now it's, then it went to counter trends, and it seems like there's a sort of catch-all for non-trend strategies. I guess I would really turn it back to the group and say, how do you define that side of it?
All right. Well, Alan, you are the one person that has allocated to non-trend, I think. So how does that feel?
Yeah, I think there's a pretty decent understanding of the taxonomy in the industry overall. I think some strategies tend to fall between the cracks a little bit. But to answer Andrew's question, I think when we talk about trend following, there is an inherent assumption that, one, it's price-based. So price is your primary input. Secondly, we're talking about medium to long-term time frame. And thirdly, we're talking about, obviously, trading in the direction of the prevailing medium to long-term trend. So thinking about strategies that don't fit within that. So say short-term strategies. So I think generally we understand short-term systematic strategies to be strategies that are of a time frame of intraday out to maybe 5-day, possibly a little bit longer, maybe 8 days average hold period. So they're distinct from trend following in terms of that time frame. Now you could be following trend following momentum strategies, but if you're pursuing them over that very short-term time frame, generally people think about them as short-term strategies as opposed to trend following strategies. So they're still kind of in the non-trend category. The second thing then, obviously in terms of the input, if your inputs are non-price inputs, then that puts you into other categories like quant macro. So if you're looking at either, market data such as yield curves or yields, etc., or you're actually looking at economic time series. I suppose recently we've had the idea of economic trend following, but even keeping the trend part of that out of the argument. But certainly non-price, i.e. market or economic time series being part of your input, well, that puts you into more of a quant macro. And then obviously the third bit is if you're not actually trading in the direction of the trend, then obviously you're counter trend. So that's very clearly non-trend as well. So that's 3 very clear categories. Obviously you can also have traders who are discretionary and they could be trend followers. So a lot of macro traders are effectively trend followers, but they manage the risk differently. They're not systematic. Their portfolios aren't as diversified. They're not trading 50 to 100 markets. But if you speak to a lot of macro traders, very often they'll make a lot of their gains from 1 or 2 big trades in the year where they capture a big move. So it is trend following in terms of philosophy, but it is differentiated from trend in terms of the discretionary input. So I guess when we think of trend, it's systematic, medium term, price-based, and in the direction of the trend. And if you're not doing that, you're doing something non-trend in some shape or form. So I think there's a fairly reasonable understanding. Sometimes you find strategies that are maybe 10 to 20 day average hold. Is that short term? Is it trend following? It is, and then obviously you have the hybrid strategies which have trend and non-trend. So where do they fit in? But that'd be my perception on it.
See, I would say one of the things, going back to what Katie was saying about preference functions, I think one of the things that's interesting about trend as an allocation is that there's a sense of permanence to it. That you can look at it over 70 years, you can model it in all sorts of different ways, and you feel like this is something. And the thing is, for asset allocators who are building capital markets assumptions, and going back to Nick's point about having an index, somebody needs to decide what they think a strategy is going to do over time. And in hedge fund land, and we know these things change a lot over time. You model equity long short in 2005. It's very different than how you would model equity long short today. I think one of the interesting things about the distinction between trend and trend is that trend should be more predictable, in that it should reflect some underlying economic rationale as to why you're able to extract excess returns at very specific moments in time, and in particular, but not get killed the rest of the time. Whereas the non-trend stuff, I think, on the other hand, it can sound really, really appealing because it often sounds great. I think it's just hard to say, I wish I'd been doing this in 1972. And for long-term allocators, I think one of the challenges for the space, and going back to kind of the language on it, Katie coined one of the best terms on the space, which is crisis alpha. And so I was shamelessly copying that for a while and attributing it to it. But the problem, as I found, is that people then made their allocation a tactical call. And if there hadn't been a crisis in 6 months, it wasn't just how they were making a decision to add it to their portfolio, it's that they were communicating the rationale for putting this weird, complicated thing in their portfolios to their clients as basically something that was going to make money in the next 6 months because the world was going to fall apart. The world doesn't fall apart. And the clients are saying, well, why do we still have it? And so I think part of the challenge is around the language and the definitions and everything else is to understand the audience of the people because there are a lot of people who will listen to this call and you're talking to a receptive audience. But the space hasn't grown in 10 years. And I think part of the reason is because the language is really intimidating, and the description of products is really intimidating to a lot of people out there who control a lot of money. Anyway, so I'm the guy who's trying to do it in English.
I love that.
Katie, I'd love to hear what you think.
The most interesting thing that happened to me in the last year or so, I had one client that came in and said to me, and I thought this was a very interesting way to put it, is they were saying, we know that the world is changing now. We know that the macro environment is uncertain, and that there's a lot of change. Whether it's crisis, whatever it is, there's change coming. Inflation has returned, and our portfolios don't like it. But we like trend following because if you think about macro trading, what I always thought was fascinating, macro trading is about 50%. Global macro is 50% correlated with trend. And the reason for this is because trend and macro traders get into the same trades. They just get into them at different times. And so what this particular client said to me that I really appreciated is he said, I've tried to source macro managers. It's so hard because it's hard to trade all of the macro themes out there. Like, how do you trade the yen trade perfectly and also trade, what's going on in other parts of the globe and Argentina and all this stuff? It's hard, right? So investing in a systematic trend portfolio is really about having a liquid global macro exposure where you're sort of capturing a good part of where the world is moving. And when it moves a lot, no matter if it's from crisis or if it's from, rising rates, you just want to be there as part of those moves. Yes, you're not going to pick the tops and the bottoms, and you're not going to be prognosticating on what the trade is, but you're at least going to be in there in those moves, and you're going to do it in a liquid way so that if the world changes, you have that exposure. And I thought that was a really interesting way to put it, is really talking about how trend as a strategy is long macro uncertainty, and it's always going to be highly correlated to macro themes, no matter what they are. So if you want macro exposure in a liquid and less manager-specific and thesis-specific way, you add some of that liquid systematic exposure. And I thought that was a really nice point that he made. And I saying it again because it was so good. So,
all right, I will jump to you, Mark, since you are up next. What have you brought along for our conversation?
Well, only because we have such an esteemed group of systematic managers beyond just trend following in the taxonomy. we've been having a number of discussions with clients and showing some new models. And I want to talk about, back testing. And what I mean by that is that, you get the comment from a lot of investors, well, I've never met a bad back test in my life. And then I said, well, would it be any better if I didn't show any of back tests? And they say, no, I want to see them. And then I show a back test, and then they'll say, well, it doesn't matter what you do. I'm probably going to discount it by 50% as a rule of thumb because, whatever you showed me in the past is probably going to do half as well in the future. And maybe I might consider it if it does half as well as what you've shown in the past. So based on those type of comments, which I'm sure everybody has heard, I guess is that what do you think is necessary to convince someone that you have a good back test? And what do you look for in a back test if you are sort of assessing an investor? Because I think that ultimately, that has a lot of value for a lot of people who might be listening of how you would look or view or what you consider as a good back test and at a very high level. Because I know that there's a lot of nuances you can look into.
Well, of course, we're super lucky because Rob has, I think, written about all of this in one of his many great books. So, Rob, what do you think about that?
Two separate questions, really. One is, how do you deal with people who say those silly things to you? And the second thing is, what do you look for in a back test? I'm very fortunate not to be, managing anyone's money apart from my own. So I just have to convince myself that my back tests are okay. And that's normally fairly straightforward, although I do sometimes run into problems if I'm in a bad mood. So I'll probably go for the second question and hope that those of you who are still, managing money can deal with the first. And that, to be honest, when I look at a back test, I'm not necessarily looking for like a really good Sharpe ratio, right? And I think this is probably the difference between, us, I suppose, as people who work with back tests all the time and someone who's just being shown one as a kind of, buy this product thing. So there's lots of other things that to me are more important than that. So, for example, if you told me you're running a trend following fund and I looked at your returns and you did really badly at times when trend following funds generally did really well, or vice versa, you did really well in periods when trend following funds have done badly, I'd have questions about, exactly what it is that you were doing. And, if it really is trend following, how come its correlation or its pattern of returns is so different? I'd also be looking at, other distributional properties apart from just the straight out Sharpe ratio. So I'd be looking at the actual risk as well. So, if the risk is very high, for example, and you're trading futures, I might be a little bit concerned about the degree of leverage you're using. Whereas if you have kind of big upward movements because you're generally a person who's buying vol, I'd be less worried because the downside is kind of naturally more limited. I would be hoping to see statistics on things like correlation and costs and things like that, because at the end of the day, what I'm trying to sort of say is not necessarily, is this widget the best widget that exists there? That's a really hard question to answer just based on a back test, and it's probably dangerous to do that just based on a back test. I think it'd be quite naive to pick one manager over another purely because they have a better back test, or the Sharpe ratio alone was better. But I would definitely pick one manager over another if the back test is Sharpe looked a bit worse. But there are other characteristics of the strategy that I expected to see were there versus somebody who had, this amazing account curve, but which bore no relation to what I'd expect.
I'd love to actually hear, well, Jim for sure, but also either Katie or Nick actually, because you probably in your model building also deal with this issue about backtesting. So maybe one of you first and then Jim.
So, backtesting is the only tool we have to bring a hypothesis into data, right? And I think in itself is the curse as well. We have a big team and we look into those patterns and how we can systematize them. I think the first thing we have to do even before running a backtest is to build some discipline and awareness. And I know it sounds very theoretical, but unless we call it out, we will all become genuinely biased by the natural temptation of just picking the best line, whether that is a Sharpe or performance in the drawdown or whatever the characteristic we're after, right? And I think unless we call it out and become conscious, it will not become second nature. So, the extent to which we can make it a second nature to our process of researching, then I think it's a matter of hypothesis forming and testing. And again, resisting temptation of looking into another result and then, oh yeah, of course, that happened, and then obviously that happened, and then, oh, it makes total sense. No, it doesn't make any sense. And I think that is the time when you do research that you say, okay, no. Now we're data mining, or now we're entering into a territory that just reading the data. And I think it's more of a culture build rather than, how do we build a system or a research engine for us to conduct the research. So that's the first step. The second step is obviously we end up having a backtest, right? So what do we do about it? And I'm going to quote some of the points that Rob made here. We have to look into some stats. And by the way, something that is better on a backtest is not necessarily better on a forward-looking basis. And even more so, something that we have on a backtest that has no impact, it doesn't necessarily mean it shouldn't be there in the first place. For example, some of the work we do is to put some kind of last line of defense in concentration risk in some of our portfolios. And your other backtest historically doesn't have any impact. But surely if the extreme scenario occurs, in principle, you wouldn't be hit as much as you would have been, possibly at the expense of not deploying some extreme exposure that ends up being your way. But those coin tosses, we'd rather not have. The last thing I would say is that in that cultural build that we're breaking in the team, we're also trying to stress the way we think about methodologies and tests of methodologies. I'll give you one example. It's not in the trend space, but I think it was quite a nice example to showcase some of the work we've done recently. We're looking at some commodity curve strategies. The classical, buying the back end of the curve, shorting the front end of the curve, doing it across commodities and so on and so forth, kind of benefiting from, the steepness in the curve on the front. And there's this notion that, the roll yield on the front of the curve is extremely expensive to maintain. So here came the hypothesis: if I short the front, do I always make money? Right? So then we said, okay, fine, let's run some sort of a Monte Carlo that tries to position itself across the curve in a random fashion, but always short the front. So really stressing the selection mechanism on the back and try to identify whether shorting the front is panacea and all the rest is just statistical fluke. So these are some of the analysis we try to bring forward, stressing the methodology, but also building the culture. I think the culture is the most important thing. Anything else just follows. Katie, over to you.
Oh, you said all the good stuff, but I agree pretty much 100% with you, all the things that you said. I think the other thing that we try to think about in addition to that is, not being overconfident, and also complexity is something that we're very concerned about, because complexity is something that is much more akin to backtest bias. So trying to sort of fix a model and sort of be smarter than what you thought before is just tinkering oftentimes. So it's really about having that philosophical view of, I'm always a little skeptical when someone comes in and says, I have the next best thing. And I said, well, there's a lot of smart people out there doing this. So it seems to me like that is more likely going to be tinkering with your process. And so really sticking to a process and having a high amount of skepticism for change and complexity, I think, is a very important part of of a good systematic backtesting and research framework process.
I think the most critical things, and Nick kind of alluded to this with the Monte Carlo simulations, is to try and remove path from the backtest. You have to do simulations and that allow for all scenarios. To the extent that outcomes depend on path, and some strategies will work because certain paths are more likely. That needs to be explicitly laid out in the data set that you're managing, so that's well understood. The second part is understanding the degrees of freedom of the strategy. So being very explicit about what the strategy can or cannot do, how many factors it involves, where those play out, and how those can be used potentially to manipulate outcomes. Those things have to be explicit when looking at a backtest and well understood and statistically analyzed, not just on some historical data set.
Yeah, I think so. I think the questions that you're getting are from people who have had bad experiences with a lot of people presenting indices that were nonsensical, right? Or backtested data that was nonsensical. I think one of the just desensitized around a certain point, if somebody came to you and said, these are the stocks I would have bought 10 years ago, you'd laugh them out of the room, right? But if you've been running a systematic strategy that is clearly codified for 10 years and you haven't changed it, and then you tell people this is what it would have looked like in the preceding 20 years, it's much more credible than if you come to them and say, we just found the holy grail of Sharpe ratios, and this is what we would have done if we'd been doing it over. So I think if you can link it to stability of the underlying strategy, and I think the second thing I would do is show them what happens if you play with the parameters. Because what people are used to seeing is somebody goes into a room, they turn all the dials on this until it comes back with a Sharpe ratio of 1.5. They come out of the room and say, we found it. Show them, what if we take the dial here and turn it from 7 to 4, and that one from 5 to 8, and we make dumb decisions in it? Does it still look close to what we're talking about, or is the backtest so sensitive that you change one parameter at the margin or something in your notes? So, when we, on the replication space, one of the things that ended up convincing people that it wasn't crazy was we could show, we'll pick the dumbest factor sets and see if they work. We'll pick timeframes that we think are highly suboptimal and see if they work. And if it works okay in those circumstances, then you're starting with, it's okay, these are the judgments that we've made to make it better. That's from being on the front lines.
Okay, cool. So I'm going to ask a question, which is unfortunately something that I wanted to ask Rich about, because I think that since he's part of that small group of people who define themselves as classic trend, I think that is more, it's one of the discussions point we've had. But overall, my question or my thought is this thing about whether or not trend followers, but even I guess vol managers as well, whether we can afford to stand still in our research. And of course, we know from some of the classic trend, they say that they actually evolve by standing still because there are fewer of them. But from my point of view, I guess I have an interesting seat because the firm I work for have been around for 49 years. And so we started out as what you probably would classify as a classic trend follower today, using volatility breakout systems as our signal generator. But later in life, about sort of 15, 18 years ago, we started to evolve that whole process. And of course, it was based on the evidence that our research team could find. And so in one sense, one thing we did was we added an extra signal generator to the process. And then later on, we also changed the whole risk management from going from a market-by-market approach, which is the classical approach, to this holistic approach of risk managing the whole portfolio using correlations and volatility and so on and so forth. And I guess what's interesting for me is that I can kind of see both to some extent. When I look inside the engine, I can see how both of those approaches have evolved from some of the research data that I have access to. So I'm curious to know, and since we can't get through to Rich right now, but let me throw it to you, maybe Katie, to begin with. Is this thing about research and whether in a strategy like trend following, for example, where you could say that we are standing on shoulders of the pioneers in terms of the golden rules. But what are your thoughts about this thing about research and how much change is too much change in our research, so to speak?
I love that question because it's one of the challenges that people often forget about our space is that it's really easy to replicate correlation, but not easy to replicate returns. What I mean by that is that you could take a simple moving average model and get very high correlation to the industry, but you don't want to invest in that. So what that means is that investing in our space is about the details. It's about getting the details right, getting the risk management framework right, thinking through the small parts, not just the big overall strategy. Another thing for me that is also very important about a philosophical trend system is really building a system that will change as markets change over time. So yes, that means you're not going to be throwing in tons of new models, but you always need to be receptive to the idea that some of your models, that you might have more diversification if you think about this in different ways. So really the goal is parameter diversification and smoothing sort of the reliance on one thing that gives you that correlation but doesn't give you good returns risk adjusted. And I think that's where we struggle because everyone says, well, I'll just use a moving average and then I get, 90 something percent correlation. Good luck trading that in practice, as opposed to, I think the real sophistication is making sure you get all the details correct.
I want to come to you, Jem, in a second because I want to hear your thoughts about research. But I actually want to first go to Andrew because I think this is quite relevant in a sense also from where you sit, looking into this industry, trying to replicate, so to speak, the sum of all of this research, so to speak. And actually what Katie said about, well, you can get the correlation right, but doesn't mean you get the returns right. You kind of have to get both right. So I'd love to hear your thoughts.
So one of the things I love about the space is I think the space does evolve over time. So we've looked at we run our own internal simple trend following models. And part of the issue that we had with it was that we don't think that if we went back to 2005, these are necessarily the models we would have chosen at that time. In terms of what we do from a replication perspective, we're not trying to actually do what managed futures funds do. We're just basically betting on some short-term stability in the correlation structure of the market. That basically, because when you think about diversification, and we believe that diversification helps enormously when you're running one of these funds. But if you're looking at it in a short period of time over the past 2 or 3 or 4 weeks, all those 70 instruments are either going up or down or staying flat. And so when we looked at it from a replication perspective, the idea was basically how confident do we feel that those near-term correlations characteristics of the market will continue, again, over a short period of time. And so it is a balancing act because we don't optimize around correlations. We are actually trying to look, all this stuff is a judgment call, and we were trying to find a way. We were more concerned about what we thought would be out of sample performance relative to the underlying index, and but it wasn't. But all the nuances that Katie is describing or that you're describing in terms of the evolution of it, the reason we like what we do versus in the US, there's an ETF that uses a static trend following model that really hasn't changed in a couple of decades, is if you guys are all doing something, if the giants decide that there's a better way to do this on a going forward basis and you evolve what you do, then a good replication of the space should adapt and follow what you're doing as opposed to making a bet that you're going to be doing the same thing in 10 years.
Okay. Jem, before we jump to the next topic, what are your thoughts on this?
Yeah, again, I'll give you a quickish answer here. So my view broadly is that markets are very much a voting machine in the short term. It has much more to do with flows and supply and demand in short time intervals. And that changes dramatically as market structure changes. And market structure is constantly evolving. So to sit and, somehow stick to models from 5 years, 10 years, 20 years ago, where market structure is very different, I think is an incredibly flawed process. You have to be constantly mindful of market structure and what's changing and how that changes the system. That said, the longer timeframes you go to, the less it's just some supply and demand on a short-term basis, the more it kind of reverts to the broader trends. So I think time interval matters a lot. I think you want to not lose the core things that are important to kind of trend and strategy over longer time intervals, but over any period less than a couple of years or a year, I think you really have to be mindful of market structure and evolving constantly.
Okay, great. So now that we've been through all of us, except for Rich, of course, due to technical problems, I wanted to throw out a quick question to everyone, and I'll call out who I would like to answer this. And this is literally something where it's like a 10-second answer, but I just wanted to sort of get your thoughts on that. And it's a very simple question. It's kind of the most important lesson that you've learned from the year 2023. And if I could start with you, Alan, just a very quick answer to what's the most important thing you've learned in 2023?
Well, I think you phrased it as learned or relearned. So it wasn't a new learning. But again, as an allocator around, it was another year of dispersion and the importance, from my perspective, of when selecting or allocating to managers of being diversified. If you look at the performance of the industry, it's flat to slightly negative overall. But, managers, plenty positive, plenty negatives. Some managers particularly challenged this year, but some doing well. So it reiterated the importance of diversification in terms of manager selection. And I think the second thing that kind of came back to me as well is the challenge of timing performance or forecasting performance from the perspective of, if we went back to the end of last year, coming on the back of a really strong year for trend following and managed futures, looking at the macro environment, you could make the case for really, a really compelling case for the strategy. Higher interest rates, also a tailwind for the strategy, but yet it was a tough year. And that's just part of the statistical fluctuation that you get with the strategy that you just have to accept. So while, people will always ask you, well, what's the outlook? You always have to caveat that from the perspective of, yes, the outlook is positive or was positive and still is positive. But year to year, the fluctuations will always be so great that is very hard to kind of forecast on a kind of a short-term 6-month to 12-month time horizon what returns will look like. So they're not new lessons, but certainly they were old lessons relearned this year.
All right, that was a long 10 seconds. So maybe we can do this a little bit quicker. Rob, anything particular you learned in 2023?
Don't be cocky. I think March taught me again that you can get kicked up the arse whenever you least expect it. The last time was Thanksgiving a couple of years ago. Same thing, You think you get ahead a new high water mark and then bang, you lose 6, 7, 8% in a day, 2 days. So yeah.
Okay, cool. Andrew?
I just how unpredictable the business is. I think if you'd gone to the end of 2022, going back to the point I made earlier, again, long-term trend looked unbeatable. And this year, a lot of the things that had been, had cramped people's returns, et cetera, last year and had caused people to get whipsawed in other years are actually working quite well this year. So in this space, it's just year to year, we'll have different winners and losers, and it's hard to know who's going to be on the top.
Sure. Jim, quick thought on what you learned?
Yeah, it'll be almost like a reference to what I just said before. Early in the year, a lot of the signs were there for too much vol selling and a potential existential risk. But this structured product supply is something that I had not been as focused on before. And the more we dug in, the more we realized the volume and size and scale of what was happening there. That was a really illuminating thing for me, and something that always kind of teaches you got to keep your eyes open for things that you're maybe not thinking about historically that aren't in the data set and how market structure is changing.
Sure. Nick, anything on your side in terms of learning, or do you know everything?
I will say you, but the one thing was just a deja vu of 2020, end of 2020. At the time, we had a variety of clients coming and feeling the act of regret and putting some long vol trades because March was like the most recent experience. Guess what happened in 2021 and 2022? All those long vols did not perform. And then this year, we've seen clients coming back and say, I want trend. Again, another act of regret, but look what trend has done this year. So I think the point is, when we look into those strategic allocations, we should be looking at those without necessarily acting as regretting what happened, but rather just looking forward and hedging all the outcomes.
Great. Katie, thoughts on 2023?
I think the biggest thing that I learned that was interesting in 2023 is we wrote this interesting paper that talked about the phases of the bond trend. And in that paper, it was a totally historical analysis, but this showed me how much history, even though it doesn't repeat, it rhymes, right? So this whole year, just looking for the flattener in the curve and looking for the bottom of the fixed income curve and paralleling that to how trend signals had done in history or hypothetical history, it was really interesting to see that there is really sort of a cycle of fixed income that we're involved in, that we're kind of seeing go from phase to phase. And so I think for me, that was really fascinating to learn sort of how history is actually sort of repeating itself, not exactly in the same incarnation, but sort of walking through that trade was very fascinating to me to see it from that perspective.
Yeah, absolutely. Mark, what was your key takeaway from 2023?
Right. I'm going to go to the esteemed investor, Yogi Berra, who said predictions are very hard, especially about the future. So, and I think that's what we find out every year in it. And in some sense, the reason why a lot of people like trend following, because at some level is that it's supposed to be to some degree non-predictive. So you sort of say, I follow what the market is telling me. I'm not making a prediction. Many other strategies, you have to implicitly make a prediction level. So if you're a value investor or if you're looking at valuations, you're making a prediction that they're going to meet and revert. So we have to always embrace non-predictability or understand predictability is hard.
For me, the biggest takeaway was really just relearning that a combination of stocks and trend following is such a powerful combination. I mean, just looking at two extremes, 2022 and 2023, I mean, they couldn't have been more different, but yet a simple 50-50 portfolio of those two assets or strategies would have had positive returns in both years, and combined, they would have done really well. So even as a practitioner and finding it really hard to embrace the stock part of that, I'm truly hoping that investors will take that evidence as a good inspiration for diversifying their stock portfolio with some trend. All right. In terms of other topics, we're going to go around as many as we can. So, Katie, I'd love to hear what your second topic that you brought along is, and let's see if we can add some answers to it.
So I think the biggest thing that I've spent the last 2 or so years thinking about is fixed income. And a lot of this coming from, we're trend followers. So we're always looking at trends at different horizons. And the interesting thing with the fixed income trend is it was a 40-year horizon in one direction. And going through the pivot to a rising rate environment led us to talk a lot about very different things. One is we were very interested in when is trend following going to be long? When is it going to be short? In what environments are we going to, what's the next phase? And we actually just have a paper that just came out that I think published today about sort of thinking about what's the next phase of the fixed income trade. So give some prefix to that. And then I would love to hear my, fellow panelists here's thoughts on this. Is that we did this empirical study where we looked at how trend signals did during rising rate and falling rate environments and conditioned that also on the shape of the curve. And what was interesting with this is that when the yield curve was inverted, trend following did very well being short and less well being long. And it was predominantly short. And then as the curve flattened out, it was much more mixed, and trend was still tended to be short, but the signals struggle. So it really sounds a lot like this year. And as you got that flatter yield curve, you started to see that pivot point to when are you going to be possibly long again? And so I think the question that we're asking ourselves right now is sort of what is the next phase of that fixed income trade? So we think it's a steeper yield curve, but of course there's a lot of ways to get to that steeper yield curve. Everyone in the marketplace tends to be very optimistic, thinking, we're going to get we're going to get cuts, and then, we'll have this naturally nice steep yield curve. I always think that there's usually a couple of things out there that people are missing or underestimating as a risk. Is it the fact that fixed income maybe has too much supply and that we could get actually that bottom of the long end of the curve at some point? Or are we going to go into a totally different phase? But I think from the trend perspective, the next natural progression is to get to that steeper curve. And I think the real macro question is, what gets us there and what is the exact shape of it? So I think that's what I've been thinking a lot about. And I think it's a really good point for discussion. And I think Rob has something he wants to say, which is good.
Yeah, and before Rob jumps in, because I want to hear his answer to that as well, I just want to mention that I actually heard on another podcast in the last day or so that apparently the Bank of America survey of fund managers that just came out has the fund managers being more bullish, more long bonds than ever before in its history. And so that's very interesting. And then something else was raised, I think, in the same podcast, and that is whether or not there is a law out there that dictates how much funding the US can do in the short end versus the long end, and whether or not Janet Yellen had were in breach of these rules and therefore had to shift much more of the future funding into the long end, by the way. Anyways, this is just what I heard. Let's jump to Rob and get some
yeah,
proper
I'm not going to
perspective here.
speculate on kind of what's going to drive the yield curve going forward, because I don't really feel qualified to do that. But spookily, I did a very similar analysis to you, Katie, but about 11 years ago. You're right that the shape of the yield curve is important. Of course, that's because that affects the amount of carry that you're getting on your positions. So if the yield curve is very steep, then your longer end bonds are going to be getting more carry. And that means that if you're long those bonds, you're getting that extra headwind from that return. But also, assuming that your trend signal is based on the total return series, or what we'd call the back adjusted price, it's a much cleaner and stronger signal. If you're trading carry separately as well as I do, then you'll get kind of a double helping of that. Whereas obviously if the yield curve's flat, then the kind of carry component of the price isn't really doing very much. And one thing that I did recently that's quite interesting is if you strip the carry out of a bunch of kind of futures total return series and look at both the behavior and profitability of trend following in those assets, a lot of it kind of disappears. So, that kind of tailwind of extra carry on the long side is I agree, is definitely an important factor. But as to where that's going to come from, over to you guys, because I've no idea.
Yeah, actually, my topic will just dovetail right into this. So I think the most important thing when looking to the future is not to try and predict an outcome, but to try and predict the distribution of potential outcomes. And I think, doing that is actually way easier. Not that it's easy, but it's way easier. Path, all kinds of things can happen between A and B, right? But understanding the forces at play and what that is likely to mean for the broad distribution is much, more straightforward to do. From my perspective, we were able to do that, for example, in 2020, by just realizing that populism had become a big thing and fiscal spending, there was likely to be a massive fiscal wave. That meant a lot of things, not just for higher rates, which is critical, as highlighted here, the most important thing, right? But it also is important to understanding the deglobalization trend and the coming conflicts that were coming. We were out there very publicly saying in 2020 that expect some big geopolitical, global, economic, and hot war to come. I mean, that people think that was an idiosyncratic thing. It's not idiosyncratic when you look at the pressures and understand the risks and understand the probabilities and pressures. It's all about incentives, as we all know. And if you start to understand those incentives better based on broad structures, you can really model distribution better. So to that end, what are those distributions like going forward? What might that mean for trend? What might that mean for volatility? Our view is that this pressure that we're seeing that is more recent is a regime change. And at the core of it is this populism, this desire to fix inequality, which has been created by monetary policy for 40 years. That is driven by a political reality by millennials on down, and a desire, who are at 40% of the wealth creation, household formation, as I've stated many times before, of baby boomers, right? And that simple reality, which seems like such a simple little thing, is so critical. Because at the end of the day, that drives a demand push structural economy. And it puts the Federal Reserve in a box. It no longer allows monetary policy to be dominant. That simple fact changes the distribution of outcomes for so many assets in so many ways. And we saw that in 2022. And in the context of that, you still see what we're seeing now in 2023, which are cyclical pressures against that within a secular trend. And so if you start to understand this, where we are secularly in a regime change and what that means broadly, and then you understand the cyclical pressures and the reaction function of it, then you can begin to model. So our view is broadly that 2023 is a counter trend year into a much bigger, broader trend. And I think that will hopefully be good for trend following broadly, given that 2023 is, again, a challenging year. I think 2022 is more the core of where the broad trend will be. I think that'll also mean more short for volatility, much like we saw in the 70s, more recessions, more volatile, seeing a lot more geopolitical conflicts, a lot more currency issues, a lot more cross-national commodity and other pressures where entities are battling and in competition. And so for me, nobody's really talking about geopolitical issues this year because narrative follows price. But the reality is that's only gotten hotter in a lot of ways. Obviously, Israel, Gaza, what we're seeing there with Iran coming into the fray, I think is, and working with Russia and China behind the scenes as a second front. I think that's something that's going to be way more important in 2023. And I think price and volatility amidst a recession and the reignition of inflation, which I think will likely come later next year, I think are all very important trends that will really be critical and important in the coming year.
Okay, great. So maybe we'll just have a sort of a more fluent conversation as we sort of slowly start to wrap up the final part. We have another 30 minutes or so. So I don't know whether, Jim, you want to throw out another topic or otherwise, Alan, what are your thoughts, Jim? Do you want to throw another topic?
I think we haven't talked, we're talking systematic trend following. I'd love to kind of discuss a little bit more geopolitics for a second, see if anybody wants to dive in and opine. But, I'm really curious to see what other people think about what's going on in emerging markets, Japan. Leave it open here. What are the things that people have on their radar as the biggest risk for the year and things that they may be thinking about as they're modeling 2024?
Yeah, and I'd love to see who raised their hand. And while they think about that, I will say to you, Jim, that I can't wait for the first conversation we're going to release maybe not the first one in the new year, because that's going to be you and I alone, but maybe the second or third, where we're going to be speaking to David Dredge. And I think he is someone who's uniquely positioned because he's based out in Asia and has a clear focus on Japan and what's changing out there. And of course, this will have massive effect, not least because of people using the yen so heavily in their funding and so on and so forth. Andrew, you have a thought on this?
Yeah, I guess, back to your point about the distribution of outcomes. The distribution of outcomes seem really wide to me. And I occasionally people get asked or ask me questions about, where do you think the S&P is going to go? Where do you think interest rates are going to go? And I fight it and I fight it and fight it. And then I finally throw out an opinion because I don't think my opinion has a much predictive value. But about a year ago, I got asked where you thought the S&P was going to be. And I said, look, we have no idea. It could be down 20% from here. It could be up 50% from here in a year. And I got asked recently about interest rates. And my personal view is interest rates are going to stay high for all the structural reasons you describe. But we could have deflation next year. People have not been wrong by a little bit on these predictions. And if I encourage you guys to look at Jim Bianco did this incredible chart of short-term interest rates since 2010, and it shows where interest rates went and where the markets thought they were going over the course of next year. And it was just, you wouldn't give a penny to anybody making these predictions. And so, I'm a perennial optimist, but when I look at the world today, it feels really dark. It feels like we have an entire generation of people whose brains have been melted by social media, that we have a profound changes in the geopolitical structure where there seem to be common agreement on certain things that no longer exist anymore. So, I think we're looking at a world today where we've had, I think Katie mentioned this point earlier about we keep having these things that just don't feel like they're sitting on a bell curve. We have a land war in Eastern Europe. We have the potential for war in the Middle East. We have taken kind of a certain level of stability in the world for granted since World War II, essentially. And so I don't know whether that's good or bad for managed futures. My view on, and for trend following, my view on the Fed last year was they finally ripped the butt off. And that was going to, in a sense, they had flipped from wanting to suppress volatility and a fear of ending up in being like Japan to the fear of being Arthur Burns. And that kind of changed the calculus. But look at the past 6 weeks. Trend following has been standing underneath the propeller for 6 weeks. And so I think volatility is going to be the name of the game. And those expected outcomes are going to be very wide.
Yeah, I'd love to hear maybe also your thoughts, Alan. But before I do, I'll throw something a little bit your way. Also, the way of Nick, but I know he's not going to comment on this particular part. And that is another thing that actually, Jim, we should raise with David Dredge. I think he put in one of his recent wonderful newsletters a plot from the Bank of England, where they have 800 years worth of inflation data and volatility, and they group it together in 20-year blocks of 20 years. And there's one block that has hardly any inflation and very little volatility, and it's like a standout plot. And it's the period from 1997 to 2016. Everything else is just completely different. So this thing about that we may be looking back, and I think that's maybe something we will do, and about the last kind of decade or two, saying that was the odd one out. I think that is so true, but of course not knowing what the future will hold. But Alan, since you also do a lot of the global macro conversations on the podcast, what are your thoughts on this?
Yeah, no, I've seen that chart from the Bank of England, and yeah, it basically shows what an outlier the last 20 years have been in terms of inflation being on target and not fluctuating much around the target. And historically, we've seen much more variation in inflation. So I agree with what's been said. The way I would summarize it is, if you look at last year, how many articles did we see last year about the end of 60-40 and the need for diversification and how the world is going to be very different going forward? And then we have a big rebound in the S&P this year, and suddenly you're not reading about the end of the 60-40 so much anymore, and everybody seems to be okay. Last year was a year where, if you go back to Jackson Hole of 2022, all the policymakers are saying, the world is going to be really volatile going forward, and we've got these structural supply constraints. And then you get a year where inflation comes down and everybody forgets about these points that were supposed to be kind of structural impediments for the global economy for the next few years. So I do think it is a question of, which is the outlier? Is 2022 the outlier, or is 2023 the outlier? And, if you go back a couple of years, Ray Dalio wrote a piece where he looked at every decade over the last kind of back to the 1920s. And, very often at the end of the decade, you'll get a change in the kind of the environment. So obviously the 2010s was very much low inflation, stable GDP at a low level, QE, low rates. Now we're into a new period of, I think, more volatile conditions. But 2022, and sorry, his point was within those 10-year periods, you will always get 1 or 2 years that are against the kind of trend. So my own personal view is that the 2023 will probably be the outlier in terms of the Goldilocks disinflationary period coming back, that people are suddenly forgetting about all of those structural kind of headwinds that policymakers pointed to last year in relation to supply chains and nearshoring and all of deglobalization, all of the things that we think might push up inflation and make it stickier over time. But, it's ironically, I would say in terms of how this impacts the bond trade and managed futures, if we're going back to the old world, like the 2010 period, there's going to be an enormous bond rally for the next 2 years, which would be great for managed futures, I would guess. But then probably maybe beyond that, it could be a bit more challenging. Whereas if we're in the new environment, it's probably going to be a bit more choppy around bonds for the next 6 to 12 months or 18 months. But you will see bigger trends over the next decade. So I'd be more in that camp. But even if you're pessimistic on that outlook and think actually the world's going to revert, bond yields would fall a lot more, and there'd be a big trend there as well in the short term. So I think there are positives to be taken from both scenarios, but I'm more in the camp of 2023 may prove to be the outlier in terms of being such a positive Goldilocks type scenario.
Yeah, Jim?
Yeah, so I would actually not take them as separate years. I'd take them together and look at them and say, hey, what does this look like? And it looks exactly like the data you see for the 14 years from 68 to 82 when we had structural inflation, yet cyclical downturns. You get significant short-term volatility. There is a lot of rotation, and particularly FX and rates and precious metals. You get dramatic volatility, way higher than the other regimes, but the market goes nowhere. in nominal terms, and we live in a world of nominal illusion, right? In the meantime, we've had inflation for 2 years, right? Where has the market really gone? The market's really, in real terms, down about 20% over 2 years. And so this is what happens if you fast forward. If you go to the 68.82, market went nowhere for 14 years. The S&P did. You had dramatic short-term volatility, dramatic recessions. You had multiple 40% declines, many 75% rallies, but long-term vol got demolished, and short-term vol actually was higher than normal. So it's actually fits exactly the distribution you'd expect given the model we're seeing. So I think it's important to kind of back up and look at the bigger picture sometimes, and not just look month to month, year to year, and really see what regime we're in.
Rob, I was going to jump to you because you stole from the others in terms of topics in the first part of our conversation. So maybe you found some more good ones.
I feel as that I should, maybe do some role playing here and pretend to be a classical trend follower, as we, due to technical difficulties with our classical trend follower, has been silenced. Although some might say it's a conspiracy, and actually, that we've done this deliberately. But there we go. So I'm gonna steal one of Rich's topics, but actually something that's quite close to my own heart as well, which is diversification. So I think one of the few things that I agree with these guys is that measuring diversification with a kind of linear measure of correlation really underestimates what you can actually get with a non-linear strategy like trend following, or for that matter, something else that's long gamma like buying vol, I suppose. Although that's not really my bag. If we are in this sort of weird new world that we were unable to kind of perhaps articulate or describe or forecast, and it's sort of different from what we've had. We haven't got this lovely headwind of tailwind of a bond bull market behind us, for example. Is diversification, really the kind of thing that everyone should be focusing on? Is this in this weird regime where we can't rely on our kind of traditional ways of making money, should we just be going all out for diversification? Alternative markets, just throwing equities, dare I say Bitcoin, just throwing everything into the big bag and hoping for the best, or is the value of diversification what it's always been, and it's not really dependent on the regime that you're in?
Okay, so I'd love to hear both from Nick and Mark on this one, and anyone else who wants to jump in afterwards. But Nick, I know you do have some exposure to alternative markets in some of your portfolios. What are your thoughts on diversification in general?
I mean, I'm looking at diversification, I guess, in Rob's question in two ways, right? How we think about diversification when we build a portfolio of alternatives, but also how we combine that with more classical asset allocation portfolios, right? So there's certainly an argument to be made with regards to diversification and the value of adding a few more assets, and obviously they're much more costly, and how you manage liquidity, and obviously if they're not liquid enough, you wouldn't trade too much of it, so then we might not have the benefit that we thought we would have in the first place. I mean, frankly, if I were to kind of pivot slightly without changing the gist of the question, and if I were to make almost like a mental jump to I guess a radical point, like we've had the 60-40 being, I guess, the pinnacle of asset allocation for decades, right? And Jem mentioned the same thing. And when we look into alternatives, we always think about a complement to 60-40. How about we replace the 60-40? And I know that's quite big, right? But what is 60-40 at the end of the day? It's a combination of two themes that historically have delivered the two more traditional rewarded premium, that being growth risk and storing your money for a longer period, therefore getting the term premium. And byproduct of that, with the anchored inflation, you had like the diversification that played out quite nicely on the downside. And what's the key risk? Well, inflation rising and then equity bond correlation skyrocketing. So there comes a point that diversification is key, but it's not about how we manage an alternative allocation. It's how we put that next to asset allocation, or possibly start thinking about replacing it, right? Because ultimately, if it's about growth risk, well, we can achieve that by selling volatility in a much more concise manner, reducing the spot movements. Or we can do, linear carry. And then you have trend following, not only to capture the opportunistic moves in the market, but also help when equity bond correlation spikes. So I would think of those alternative strategies, however we construct them, to a certain extent in a diversified format. So again, to Rob's point, we have to be very thoughtful, and I'm personally like a big believer, not of just diversification, but prudent risk management in how we build those portfolios. But ultimately, that's the radical point I'm going to leave you with, right? Is it about complementing 60/40 or really reshaping how we think about it on a forward-looking basis? So big question mark here. I don't have a good answer. There you are.
Maybe Mark does.
I don't have an answer, but I want to go back to this geopolitical issue because it's always fun to have geopolitical discussions, but at the same time, we have joke in a lot of our investment meetings with my partners. We sort of say like, you can't use the word feelings. Feelings are banned. So I always sort of think about as systematic managers, what we're really thinking about is there's two views. One is that you could say what we want to try to do is identify regimes. Regime identification could be in a machine learning. It could be supervised or unsupervised. Supervised, you'd say like, okay, this is where we are in the business cycle, and here's what should happen if we're in this regime. It could be unsupervised. You say like, well, I'm looking at data and said the data seems to change to tell me I'm in a different regime. But ultimately, then the question comes for a model builder, is that, do you care whether we're in a different regime? Now, some would sort of say that I'm regime agnostic, that it doesn't matter what regime because my models do what they do. And whether you say I'm in this point of the business cycle or if I have this geopolitical risk or this event is going on, I'm indifferent because my models sort of just run no matter what because, it doesn't sort of incorporate regime. The other view is to sort of say like, well, I want to be regime dependent. Okay. If the shape of the yield curve has changed, I might change my behavior. If, let's say, I'm at a different point in the business cycle, I might change the weights of my exposure. If I'm in a different type of regime, I might do something different. So the real question comes from a systematic manager is that, are you regime agnostic or are you regime dependent? And if you're in either one of those, how do you incorporate that in models? And so I don't have the answer because that's why I'm asking you, and that's why we're on a panel. But so that's the way I sort of framed the problem.
Andrew, you get the last word on this topic, and then we'll finish off with a quick round of outrageous predictions.
Sure. Well, I mean, I just sort of, I guess, to respond to both things. I mean, I think the evidence is that it's incredibly hard to predict what regime we're in. And even if you get the regime right, you get the macro call right, figuring out how to make money off it is, I think this, you go back to another lesson of this year. If you nailed that, I know guys who said, all right, we're basically buying value stocks on the thesis that interest rates are going to go up. Interest rates go up and value stocks get killed because AI comes out of nowhere. But I think just think in terms of the broader managed futures space and going back to what Nick was saying, this change in correlations in stocks and bonds, if it persists, and AQR and others have put out, I think, pretty strong evidence that if inflation stays above, maybe 2.5%, you're likely to have positive correlations between stocks and bonds. That's an earthquake across the asset management industry because the whole model of diversification was so easy. The rolling standard deviation of a 60-40 portfolio in the US by the mid-2010s was 4%. The Sharpe ratio was well north of 1. It outperformed 98.5% of hedge funds over the course of the decade. So, but the underlying assumption was that stock and bonds correlations would remain negative. And so when people built their asset allocation models, the easiest thing for them to do was to say, okay, I've got equities over here, and then I'm going to add a little bit of private equity because it's kind of close to that. And I'll expand into EM, I'll do other things. But you basically had two legs of an asset allocation stool. The flip in correlation means that everything's converged. So we have this pithy expression, which we coined back in 2022, that then at a time like that, when everything is going down, you have the sea of red across your portfolio. It feels like the correlation of everything goes to 1. Managed futures is this beautiful beacon of green, right? And in September, that was true. In October, it was true. We are a nasty red blotch in a sea of green this month or over the past 6 weeks. So I think the key, though, is that fast forwarding to 5 years, the guys that we talk about, the allocators who are going to look good in 5 years, are the ones who embrace the idea that this core tenet of diversification has changed. And whether you throw out 60-40 and say, I don't need bonds anymore because they're not hedging and I'm just going to take equity risk, or whether you go to a 50-30-20 model or you look for other sources of diversification, the vol on a 60-40 portfolio is more than double what it was a few years ago. And so clients and institutions that have been promised a smooth ride are not getting it. And that's where I think managed futures is almost uniquely positioned to serve as a vol dampener because of its long-term characteristics.
Great, Andrew. Appreciate it. All right, well, we're going to wrap up this epic conversation that we've had and that people have listened to in the last couple of weeks with a quick fire round just in terms of some outrageous predictions for 2024. And I'm going to jump and start with you, Rob. What is your outrageous prediction for 2024?
My outrageous prediction is that I will indeed turn to the dark side and become a classic trend follower.
Okay, that is outrageous, actually. Alan, what's your outrageous prediction?
Mine is it's a market forecast and maybe not so outrageous the way things are going, but I'd say 10-year yields to trade below 3% next year, and above 5% by the end of the year.
Okay, nice. Andrew, what's your outrageous prediction?
I think we'll realize by early next year that people have no idea where we're going. that we're tearing up a lot of old playbooks, and maybe it's not outrageous given what's happened, but I think we are seeing a recognition that macroeconomic forecasting is not doing very well for us.
Fair enough. Jim, I'm sure you might have some outrageous predictions since we speak a lot about these things.
I have two, but Alan kind of stole one of mine. I was actually going to say trades down to 3.5 and then gets above 6% by the end of the year. So that's pretty outrageous given the current assumptions. And in the process of that, the curve actually steepens. 10-year yields actually go higher eventually with lower short-term yields. And then the second one, China starts moving on Taiwan at the end of the year.
Wow. Well, Nick, can you top that with your outrageous predictions?
I have two different points on prediction, if I may. Number one, okay, so there's a very nice paper by Tetlock called Super Forecasting. It basically says when people make predictions, they're actually lacking two important points. Number one, the time horizon. Thanks for setting at least the time horizon right next year. But second one, not actually being checked regularly on their predictions. So the first thing we have to do actually get here in a year from today and actually see where those predictions got right. The second thing I'm going to say is that I wrote a paper about 4 years ago basically saying that when we try to time or make a prediction, what we have to not forget is the base rate. If it's a coin toss, 50% chance point something is enough to get us in a better place. But when we're talking about investments, and I'm thinking about investments more than macro in a particular way, these are all like high Sharpe ratio strategies. In other words, the hit ratio of just holding them is 60, 70%, whatever. You can work it out, right? So my point would be, it's hard to even call the shots. I'll just go for diversification on this one. I'm not going to make any call because I think 2022 and 2023 got everything wrong in a particular way. So these are the 2 points that I have.
Great stuff. Katie, what is your outrageous predictions for next year?
Oh, I definitely got myself in a corner saying 6% this year. So we did get 5%. I do kind of agree the outrageous call would be that we did see that massive steepener later next year at some point. So I think my guess is that we're going to see a steepener, but I'm going to be open to the range of possibilities of how steep that steepener is and exactly how that occurs.
Good stuff. Well, Mark, what is your big outrageous predictions for 2024?
Well, the important point on making an outrageous prediction is make sure that it's going to be very hard for a measure so I could still be correct at the end of next year. And so I'll say something that 2024 will be the year that debt matters. In the sense, this is that supply of debt, and debt, especially on the government side around the world, is going to have an appreciable impact in a way that we haven't seen. Now, of course, you measure that in and rates and such is fairly difficult. So I could say debt matters, and next year I could assure you that I could come back and say my prediction is probably true, but I won't say how we'll get there or what that means.
All right, good stuff. Well, that kind of leaves me with the last outrageous predictions. I have two very different one. One is that neither Joe Biden nor Donald Trump will be part of the U.S. election, probably for different reasons. And the second one is that DBMF will start to inflation adjust their low fixed management fee to cover the cost of inflation. There we are. We'll see if any of those come true. And we'll have to go back next year in our session in a year's time to see if anyone got close to our outrageous predictions. That is it for part 2 of our 2023 year-end special group conversation. We hope that you enjoyed it. And if you did, perhaps as a sign of appreciation to all of my co-hosts, you could take 5 minutes of your time and go to Apple Podcasts, Spotify, Amazon, or wherever you listen to your podcast and leave us a rating and review. This will mean a lot to us. And while you're there, make sure you follow the podcast, as this is also very helpful for us to grow the show. And if you want to receive my weekly newsletter, just head over to toptradersunplugged.com/TTU-news. From all of us at Top Traders Unplugged, thank you so much for listening. We look forward to being back with you next week for our regular weekly conversation, and where I will kick off the year with Jem, what I'm sure will be a much anticipated conversation by many of you. If you want Jem to tackle some of your questions, or if you have suggestions for topics, you can, as always, email them to me at info@toptradersunplugged.com. Until then, Happy New Year, and take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.